Hello, everyone, and welcome back to my channel. Imagine checking your investment portfolio. Your shares have gone up in value, your house is worth more, but you haven't sold anything. No cash has hit your bank account, and yet the government sends you a tax bill. It sounds unbelievable, but that's exactly why investors around the world are panicking over a growing idea known as unrealized capital gains tax. Some are calling it the biggest threat to investors in decades. So, what is it? Why did South Korea's stock market plunge after the idea was floated? And could Australia or other countries be next? Let's break it down. So, what is an unrealized capital gain? Normally, capital gains tax is simple. If you buy shares for 100,000 and later sell them for 150,000, you have made 50,000 capital gain. You realize the gain because you actually sold the asset. But an unrealized gain is different. Let's say your shares rise to 150,000, but you don't sell them. You have made money on paper, but you haven't actually received a single dollar. So, under current tax systems in countries like Australia, you generally don't pay tax until you sell. The controversial proposal would change that. Instead of taxing realized profits, it would tax increases in value even if you have never sold the investment. So, why markets have suddenly panicked? This debate exploded after South Korea proposed a tax on unrealized gains for certain investments. The market reaction was immediate. Billions of dollars were wiped off share value in a single trading session as investors rushed to sell, fearing future tax liabilities. The broader concern spread beyond Korea and contributed to weaknesses in global markets. Investors fear one major problem: where do you get the cash to pay the tax? Imagine owning a family business or farmland or investment property. Its value rises significantly, but it produces little income. You now owe tax without actually receiving any money. The only option? You might have to sell part of the asset simply to pay the tax. That's why critics argue it creates liquidity problems for long term investors. Could this happen elsewhere? The idea isn't limited to South Korea. The Netherlands has debated similar proposals. Australia previously discussed taxing unrealized gains in some superannuation settings before later backing away from that specific approach. More broadly, Australia's current tax debate has focused on reforms to capital gains tax and negative gearing rather than introducing a broad unrealized gains tax. Supporters say wealthy investors often accumulate enormous gains without paying tax for many years. They argue that taxing unrealized gains could make the tax system fairer and generate additional government revenue. Critics disagree. They argue that asset prices fluctuate constantly. Imagine paying tax on gains this year, only for the investment to lose value next year. So you've already paid tax on wealth that no longer exists. That's one reason why broad taxes on unrealized gains have proven politically difficult in many countries. Now, why this matters to everyday investors, even if you don't own millions of dollars in shares, this debate matters. Policies aimed at very wealthy investors often influence how markets behave. If investors sell assets to avoid future taxes, markets can become more volatile. Business investments decisions can change and confidence can fall. Whether you agree with the policy or not, it's a reminder that tax policy can move markets almost as much as interest rates or company earnings. In conclusion, for now, most countries, including Australia, still tax capital gains when assets are actually sold, not while they're simply increasing in value. While governments continue to debate tax reform, no major economy currently operates a broad annual tax on unrealized capital gains across all investments. But the fact that governments around the world are discussing these ideas show just how much pressure there are under to raise revenue. And if history has taught investors anything, it's that tax policy can change faster than many people expect. What do you think? Should governments be allowed to tax wealth that only exists on paper? Or should tax only be paid after you have actually made the money? Let me know your thoughts down in the comments below.